Welcome to Time Freedom Daily. This is where you're going to get your daily dose of knowledge to help you attain time freedom, financial freedom, all that good stuff, everything in between. And Chris, how you doing today, brother?
I'm doing great. How are you? I went and rode the levee, which is not the trails this morning. It is the levee that goes around the Everglades, and
Awesome.
so
How
it's
many miles you do today?
just 18,
Oh, just 18.
just 18.
My butt hurts just hearing about that.
For me, that is work. Like I would much rather be hitting the trails and dodging trees, but sometimes it's right there, so it's easy for me to get to, and it's my cardio. So
Awesome.
it
Awesome.
was cardio day.
That's great, man. So, Chris, what are we talking about today?
So today is Financial 101 Thursdays. Just to kind of give the viewers and our friends and our family some idea about how to, reach that retirement goal and just kind of like, a lot of people don't even know where to start. A lot of people have never invested in anything. Where do you start? Where do you go from day one? Are you taking advantage of your 401k? So I know you're going to go into some of that stuff. So yeah, have at it. And, I'll give my 2 cents where my 2 cents is valued.
Absolutely. I think you're valued up to $1 right now. So we're good with our information for sure. So yeah. So folks, I mean, first off, let's just state right off the bat, this is not financial advice. We're not financial advisors. We're not financial planners. This is just information that we've learned along the way. And we want to share that because so many people don't understand till it's too late the value of investing and the power of compound interest. I mean, it's funny, if I would have learned the power of compound interest when I was 18 or 19 years old, I would have understood what I needed to do. And the power of time in your hands when you're early on. And I mean, right off the bat, I've told Chris this before. I've got two IRAs, custodial IRAs set up for my kids. And my one son's 17, my daughter's 12. And as long as they're earning some money and that money can be earned at home doing chores around the house, they can go ahead and invest that money and have it compound over time. So, the first thing you guys got to understand, and I'm going to go over this chart here in a few minutes, is the power of compound interest. And it really is powerful. And we always say in a lot of our streams, and you're going to hear us saying it many, many times in the future, it's not about timing the market, which means trying to figure out when the market's going to drop and when the market's going to rise and trying to get your money in and out. That's not what investing is really truly about. It's about time in the market. Right. How much time do you have your money working for you, and how long do you have for that interest to compound year after year after year to have a nest egg when you are done and when you're ready to retire? I mean, I'm the type of guy that I probably won't ever stop working on something, but to be set up to where you don't have to is powerful, because one thing that we have to really understand is that we're living longer. And also, there are so many companies out there that don't have any more pension plans. They may offer you, some type of a match on your 401k, which is a tax-deferred interest platform that will allow you to earn money for your retirement and save. And they don't offer that very much. And if they do, it's very minimal. So it's really up to us. If it's going to be, it's up to me is what it really needs to be. So you really need to take your time. And what Chris and I have done over these years is read, watch podcasts, watch YouTube videos, tap into the people that have done what we're trying to do and have made the mistakes and told us what to do and what not to do. And, the need, and I'm not knocking financial planners, but there's really not a need to really have one unless you've got millions upon millions of dollars in the market and you need to know all the bells and whistles of what you need to do with that money. But the most important thing to do is to take action and do it yourself. So the first and foremost lesson that I need to share with everybody out there, and you don't need to write it down, but you should write it down. You should have it plastered everywhere. Spend less money than you earn. Can you imagine all of the debt and how many millions upon millions and hundreds of millions of dollars credit card companies earn from somebody who's put $4,000 or $5,000 on their credit card that they couldn't afford to spend in the first place,
Right.
and are making their minimum payments? You're going
That's
to end
huge.
up, Chris, you talk about that for a second.
That is, and I don't know if you saw the meme going around the last couple of days, and it's a shout out to all the people in the laundromats with their new iPhone 13 Max. Right? And the guy said, like, without that phone, you could have bought your own washer dryer set. And it's so true, but it's like I've been talking about, and it's very apparent here in South Florida. Most people live this different lifestyle and live, at 99% of their means or 120% of their means. And it's very, I don't want to say it's an American way or it's a South Florida way, but I traveled Scotland. Took my dad, or my dad and I went to Scotland about 8 or 9 years ago, and we traveled around Scotland. And Scotland, a lot like Canada, where I'm from, people will buy a car and drive it until it's dead. A 15-year-old car, like, people are proud of that. People are proud of buying a Honda Accord and keeping it until it has 180,000 miles on it, and then passing that down to their kids. And it's a very humbling way of life. You can live with a lot less than you think you need. But
Sure.
It's not to say you don't need to spoil yourself. And when you work hard, I enjoy a nice car and I enjoy nice things, and there's nothing wrong with that. But remember, like what John just said, that you got to spend less than what you're bringing in to be able to ever do anything, and that
Sure.
is the key.
Absolutely. So, hammer that home, write this down again, spend less than you make. And that allows you to set something up so that you can build for your future. Because think about how much in medical expenses you're going to have. You're going to have living expenses. Social Security may or may not be there when you're ready for retirement. We don't know. And the government is now spending so much money that they're continuously having to print new money to cover their costs. We're talking about trillions of dollars in debt. I remember I was just out of high school. I was in college, and I want to say it was Bill Clinton that was the president. And I remember we actually had a surplus. We were not in a deficit at that time when he was president. And then George Bush came in. Unfortunately, we had what happened with 9/11, and we went to war. And when we went to war, which I'm not saying it wasn't justified, we went into that deficit, and that deficit just kept growing and growing and growing as we put more into the military, more into all this stuff, more into foreign aid. And, look, let's be good stewards to our world, but let's take care of our own people. We've got children and people that are homeless and they're going hungry every day. That's a whole nother story. But, what I'm saying is that we have to take care of ourselves for our futures, for our spouse, ourselves, our kids. We have to set good standards of what we need to do for our lives. So spend less than you make. That's the most important thing. The second thing you need to do is understand the power of compound interest. And the more time you have for your money to work for you, the more that you can earn and put into a retirement account. So do your research, go to platforms and companies like E-Trade, TD Ameritrade, Schwab, some of the major companies out there, and set yourself up with an IRA or a Roth IRA. And the basics between those two, your IRA is basically a tax deferred. You are going to take money out of your salary, pre-tax dollars, which means they haven't been taxed yet. You're going to put it into an investment, and then you're going to pay at the end whatever your tax rate is on that money. But that money is going to grow tax deferred, and you're only going to get charged on the interest of what you're taking out in your disbursements. So it's a really good way to set aside if you need a tax break. If you're, let's say you make $50,000 a year and you put $10,000 a year into your or whatever your max is, let's say 6,000, I believe, depending on your age. you're going to have that $6,000 taken off the top. So when you're doing your taxes, or when your accountant's doing your taxes, it looks like you made $44,000 and not $50,000. The other option is what's called a Roth IRA, and that's what you're only able to put the same amount in. Let's just say for most people it's $6,000 right now, and you're going to do that with after-tax dollars. So after you've gotten paid and the government's already taxed you with your federal income tax or your state tax or your city tax, whatever the taxes you have in the area that you live in, you're going to put that money in after the tax. So that at the end, it's going to, through the time that you're investing, it's going to grow tax-free because you've already paid tax on those dollars. So when you take that money out at the end, there is no more taxes you need to pay on it because you've already paid taxes before it went into your savings account, which is called a Roth IRA. The other investment tool that companies offer, and if you have a company that offers it, take advantage of it, is called a 401k. A lot of people have heard about that. So that's going to be pre-tax dollars. And then your employer usually has a match, whether it's 2% match, whether it's 5%. It all depends. Some companies will match 50%. Some companies will match 100%. It all depends on how generous your employer is and what they have there for you. But I would max that out before you put any additional money in one of the Roth or the regular traditional IRA. Max out your 401k first. That's the most important thing. And then in a 401k, they're going to have a handful. Most 401ks don't allow you to invest in stocks and a lot of the other ETFs. They have mutual funds and funds that they're managed, and there's a fee charge for it. But again, that's just what the 401ks allow. When you're going into your Roth or your traditional IRA, you can invest in whatever you want to: stocks, ETFs, funds, gold, all kinds of different things, whatever your platform allows for. So let's just talk about time in the market, because it's really, really important. Mm-hmm. So if you have 40 years to save, you're right out of college, right? You want to retire at 65, right? You're 25. You've got 40 years to invest. To save a little over $2 million, you would have to put in $850 per month. That would have an average return of 7%. So sometimes you're going to have years that you're going to have 20% gains. You're going to have some years that you're going to have negative 2% gains, depending on what the market's doing. But let's just say, which has been the average, between 7 to 9%. But we're going to go with the 7%, a really kind of reserve number. You're going to need $850 to earn and have $2.036 million by your retirement age of 65. So another thing to think about, you may have the ability to have Social Security. So you may have that. So that's also going to supplement your income. But again, because we have so many people retiring and less people working, putting money into the fund, money is running out. That's a whole nother topic for a whole nother stream. But don't rely on Social Security. If you are, you're going to be sorely, sorely mistaken. If you have 35 years to invest, you're going to want to invest $1,250 a month into your retirement account to reach a little over $2 million. 30 years, $1,800 a month. 25 years, $2,700 a month. If you've got 20 years before retirement, $4,100 a month. So you can see, the shorter your time frame, the less time you have for your money to compound and earn interest and build upon itself over years. 15 years of retirement time, you need to put in $6,800 a month. So it really starts to go up dramatically. And there was this one article I read. If you were to put in $50,000 before you were at age 25, you would have, and never put another dollar into your retirement, you would have well over $1 million saved just from that money for those first few years of your working career, if you're able to do that. Because a lot of times when you're just getting into the job force, maybe you're still staying at home, maybe you're living with 2 or 3 roommates, and your bills are, much smaller. Put in as much as you can to get that nest egg to start building for you over time. And that just goes to show time in the market is what's really, really important. Look, don't be overwhelmed by these numbers, but I'm really just trying to point out how time if you use it correctly, can work in your favor. Or on the flip side of that coin, if you allow time to go on, live above your means, spend your 30s and 40s paying down credit card debt that you shouldn't have had in the first place, and then we're like, oh, I'm 50 years old. I'm going to retire in 15 years. Oh my gosh. Look how much money I need to save for me and my family and my spouse to be set. It's crazy. So, time in the market is really important. But let's talk about for a moment, and Chris, you have anything to add to that?
Well, the only thing I was going to say, like, those numbers are, they're eye-opening. And let's face it, most of us, when we're in our 20s, we're not thinking about when we're 60, 65. We're not. I wasn't. I don't know if you were.
I wasn't.
I mean, when you're in your 20s and even in your 30s, you have that feeling of invincibility. You have that feeling that everything's going to work out, which kind of brings us to where we are now. Both John and I had to figure out a little later in life that, hey, that would have been great, but what do you do now? Right?
I hear you. Yeah. So, the first thing you need to do is create a budget. Mm-hmm. If you don't understand what you're spending your money on and where your money is going, you have no idea what you really need. So make a budget and stick to it, and make sure that budget is lower than what you earn. Let me say this. I'm going to say this really close to the microphone. If it's important to you, you will find a way. If it's important to you, you will find a way. So don't put your retirement thoughts off until you're age 50, because you're going to get stuck. You're going to find out that Social Security is not what you thought it was going to be. You're going to find out that now you got to put the majority or half of your, or more than half of your income in a retirement account to have yourself to have money when you retire. We're not even talking about investments in property. We're not talking about, going on vacations. This is all stuff that you have to budget for. I remember, before I've had some success I've had today and had, more choices that I have now, I would talk to, my wife and say, okay, where do we want to go this year? Mm-hmm. Oh, let's go to the Bahamas, or let's go on a cruise, or let's go to Mexico. Okay, we're going to need to put away X amount of dollars per month. It's going to take us 8 or 9 months to get there. And that's what we needed to do, because it was important for us to be able to live on a daily basis, live within our means, and not live paycheck to paycheck. Living paycheck to paycheck is the majority of our, the people in the United States right now. It's scary, and it's because they want that iPhone before they go and do their laundry. Yeah, it's a sad place to be in. And remember, your children are watching. Mm-hmm. If you're not careful with the actions that you do, this is what your children are going to learn, and then they're going to be making the same mistakes. History is going to rhyme. It's going to do the same things over and over again if you don't change what you're doing on your day to day and setting the examples you need to set for your kids. I mean, I got a book on my shelf right now. Let me see if I can grab it real quick.
Absolutely. I was going to say, setting a budget alone can change your life. Most people have no idea how much they spend at Starbucks every week. Yeah. Or dinners out, or buying that lunch every week instead of making a lunch and doing it. Once you start adding up those frivolous dollars that are spent each day, it's staggering. I've done this with friends of mine that just, they'll go to Starbucks or Dunkin' Donuts or something in the morning, then they'll order lunch, and then they'll go get something in the afternoon, and all of it is unnecessary dollars. And when they start adding that up per week, per month, per year, it's a staggering number. And when you think back, all that money could have been saved and put into Bitcoin. Like, it is alarming how
right.
Life-changing just budgeting can be.
So I wanted to show this book here, and my computer is there we go. All right. So Make Your Kid a Money Genius. even if you're not. Chris, can you see it? Is it coming in clear?
I can. I'm just typing that in
Okay.
the comments here.
Yeah. And, I got this book for my son, and I've read it myself. And it really just goes over the basics of getting ahead of the game and understanding compound interest, some of the basic stuff that we're talking about today. And, you have to understand that we have to start. We have to start. And we don't need a financial genius to run our money. We can learn about all this stuff like Chris and I have done by just going on YouTube, reading a few books. It's all laid out for you. There's a bunch of simple books that really just go over the basics, and everybody thinks it's rocket science, and it's not. I started doing little things, in my late 30s and early 40s, and it has grown and grown and grown. And understanding your money, where it's going and where it shouldn't be going, is one of the most important things. So, just to give you an example, let's just say you make $4,000 a month, whatever that number is. Go to your most needed bills first. Put some discretionary spending, stick to it, and then whatever's left, make sure that that's going into a retirement account, and make sure you're investing every single month. Put it in there, have it go directly out of your check if it's in a 401k in your company, or have it. You can actually call wherever you get paid if they don't have 401k, and set up direct deposits directly into your IRA or your Roth IRA that you have set up on one of the platforms. That money will be in there. It's going to sit there. You still have to invest it. Log back into your E-Trade account or your Ameritrade account or whatever it is, and go buy a S&P 500 fund or a stock market fund. Don't go crazy. If you want to buy Tesla, buy Tesla. If you want to buy Google, buy Google. But a lot of these funds already have those companies in there. So the S&P 500 is the top 500 performing companies by revenue, and they have all of their stocks in there. So you're getting the ups and downs from the top 500 companies. You don't have to go rack your brain and figure out what you need to invest in. Could you take, like we were talking about yesterday in crypto, could you take 15% of it and go a little bit more risky? Something you heard from a friend, a tip you found from somebody? Yeah, sure you can. But if you really want to just capture those top 500 companies, invest in the S&P 500. There's a stock ticker out there called SPY. If you want to go on the NASDAQ, and the NASDAQ is more of the electronics and the more cutting edge companies, QQQ is the ticker symbol that takes the NASDAQ, their top companies. So it's that simple. You don't have to have 25 different stocks in your portfolio. You can have one that encompasses 500. It's super simple. Just do that. Those are giving you your average gains of 7 to 10% annually. You may have some down years, but if you look at, they say when in doubt, zoom out. If you look at the stock market, you zoom out, you're going to see it going up, down, but more on an upward trajectory. And that's what should continue, because why? Our economy is growing. And as economies grow, stock prices go up. So, that's what you need to look at. And how Chris and I, our standpoints on crypto, and I'm going to say it again here, I believe it's irresponsible. It is not financial advice. This is my personal opinion, to not have some Bitcoin in your portfolio. There are only 21 million ever going to be created. There are 24 million millionaires in the United States alone, not even talking about the rest of the world. And it's going to go up because it's going to be the new gold. It's already starting to be the new gold. All we need to do is get to a market cap where gold is right now. And gold has gone down over the last year, where Bitcoin's going up like 500%. Because smart money, is moving away from that commodity and moving it into a new commodity, which is digital gold, which is Bitcoin. So right now, our market cap for Bitcoin is about $1 trillion. To get to a price, and our price is about $55,000. to get to a market cap where gold is right now, which is about $11 trillion, and we get there with Bitcoin, which we will, and I'm probably saying sometime before the end of this decade, so we're only talking about 8 years, that translates to a price of over $500,000 per Bitcoin. That's a 10x from here. If we get 50 to 60% gains in our stock market, that would be a pretty good return over that same time frame. So what would you rather have? 10,000% gains, a 10x, or 60% gains? I mean, if you want to be safe, go there. But I think it's a pretty safe bet. Again, my personal opinion, not financial advice, to have some of your money in crypto, and Bitcoin in particular, because that's probably the safest bet. So other than that, Chris, that's really what I wanted to show. Spend less than you make, create a budget. If it's important to you, you'll make it happen. If Starbucks continues to be more important to you, or grabbing that handbag that just came out, or buying those new pair of shoes that you really didn't need because you got 17 other pairs in the closet, just because your friend can afford to and makes a lot more money than you and they got it, and you're playing keeping up with the Joneses, this is where you're going to fail yourself, and you're going to fail your future self. And that's sad. In the future, Chris, we're going to talk about, real estate and other types of investing, whether if you had that money, what to do. But that's really just a little snapshot, a little financial 101 of compound interest, budgets, savings, understanding what time in the market can do for you, and a little opinion about crypto. So, Chris, what do you have? Some ending?
No, that was gold. I will wrap the whole thing up and say, like John said, you don't necessarily need a financial advisor, but you need education. Don't go into the market, in any market, whether it's the stock market, real estate, crypto, anything at all, without educating yourself and using money you can't afford to lose. A lot of people have gotten into a lot of trouble that way. I like I said early in my investing career, I made mistakes. I've lost money. I'd love to get back, but I've wrapped my head around it, and that was part of my education. But don't just go in and throw money at something without doing your own research. And like John said, we are not financial advisors. We're just sharing what's worked for us. Just trying to share, some of what we've learned through our years. But education, investing in yourself, like I said yesterday, is always the best investment to start with. And just spend some time looking around, spend some time listening to what John says, what I say, what a bunch of the YouTubers say, and do as much research as you can, and invest a little bit. And then invest a little more. And as you learn, your investments can go up.
Absolutely. I love it. So just start somewhere, whether that's the education process, like Chris says, whether it's opening up an account and throwing some money in, whether it's putting more money in your 401k that you forgot that you had and your employer contributes to, start. Because the more you wait, the more struggle it's going to be to get yourself ready for when you're done working.
Very true.
Awesome.
Absolutely. And that will wrap up our stream for the day, guys. That was awesome. Thank you, John, for all that knowledge. That was excellent. If you guys like this, remember to hit like, remember to hit subscribe, and if you can, share our video out. Share some of this free knowledge. This has been free, guys. So we will see you guys tomorrow.
Have a good day.